The laws in South Africa surrounding the taxation of foreign investment income have changed considerably in the last few years. In years gone by, an amount of 3,700 Rand of foreign dividend and interest earnings was exempt, but this has all changed over the past few years. Interest earned from offshore investments is now fully taxable without any exempt amounts being allowed, but the taxation of foreign dividends earned by SA taxpayers is a bit more complex. SARS will add only an amount of 15/41 of the foreign dividend earnings to your income for tax, and SARS will of course only consider 15/41 of the taxes deducted offshore when you come to claim taxes already paid or deducted offshore. You will have to forfeit the rest of the tax deducted offshore. You must remember all this when doing provisional estimates of taxable income and related estimates of taxes already paid or deducted. It can actually get a lot more complicated when estimating the amounts of tax deducted offshore that you may be allowed to claim on provisional estimates. You have to include only 15/41 portion of the total foreign dividends in your provisional estimate of taxable income. You should take as much care as possible with a provisional estimate to see exactly how much of taxes deducted offshore you will be allowed to claim, and this may mean doing a comprehensive assessment estimate for the full year. Where a taxpayer has claims for taxes deducted offshore from foreign investment income, then a provisional estimate now requires a lot more work than in the past. Let's see how the WinTax software program handles income from foreign investment sources. This taxpayer earned 300,000 Rand in salary in 2017 and paid 49,780 in pay as you earn. If we now look at the foreign income screen, if this taxpayer earned any foreign interest under code 4218, then it would be fully taxable. A special procedure also now applies to foreign dividends. We can see that this taxpayer also earned R1 million in foreign dividends and 100,000 Rand in foreign tax was deducted offshore as a withholding tax. That means that the offshore dividends were taxed at a modest 10%. Although we enter the full amount of R1 million here as code 4216 foreign dividend income into WinTax, SARS and WinTax 2017 will automatically only take a portion of this R1 million as being taxable. The portion will be 15/41 of the R1 million, which is 365,854. International agreements amongst tax regimes around the world see dividends taxed at around 15%, and our top rate of personal tax is 41%. Now, if I drag the auto summary screen over this screen, we can see the total income for tax is 665,854, made up of 300,000 Rand local salary, plus the 365,854 Rand taxable portion of the foreign dividends earned. We can also see that the tax due after the primary rebate is 179,640, and we have only paid 86,365 Rand, leaving us with a due by you of 93,274. You see, SARS says that it's only fair, as SARS allows you 15/41 of the foreign R1 million dividends earned as income for tax, that SARS will only allow you to claim 15/41 of the 100,000 Rand tax deducted offshore. This means that you must forfeit 26/41 of the 100,000 Rand tax deducted offshore, which means you forfeit 63,414 Rand in this case. The balance of 37,561 plus the 49,780 of pay as you earn is your allowable taxes paid amount of 86,365. In this case, you are left with a due by you shortfall of 93,274 Rand. Now that was pretty straightforward and fairly simple. What about a case where even more tax was deducted offshore? What if the dividends were taxed at 30% at source overseas? One would think that if an extra 200,000 Rand in tax was deducted offshore, then our due by you of 96,000 odd would disappear. We can immediately see that our due by you has decreased, but it is still a substantial 23,739 Rand. You see, SARS will never refund us for too much tax having been deducted offshore by a foreign country. In fact, SARS introduced Section 6 Quad to limit the amount of tax we can claim in cases like this. Let's have a look at the Section 6 Quad calculation using our example and see what 6 Quad restricts our claim to. This is the 6 Quad formula which limits claims for foreign taxes deducted offshore. The formula is taxable foreign income divided by taxable foreign income plus taxable local income multiplied by the tax due on the total of taxable foreign plus taxable local income. According to the 2017 tax tables, the tax due on taxable foreign income plus taxable local income would be 193,140. Here is our formula. Taxable foreign income is 365,854 and taxable foreign plus taxable local income is 665,854. So 365,854 divided by 665,854 multiplied by 193,140 equals 106,121 Rand. This is the 6 Quad limit on our claim for foreign taxes deducted offshore in our example. We can see the tax due after the primary rebate is 179,640, and we can also see that we have paid 49,780 Rand pay as you earn. Added to that, our 6 Quad limited foreign tax means the allowable taxes we can claim is 155,901. As the tax due is 179,640 and we can claim taxes paid of 155,901, it means we still owe SARS 23,739 Rand. If we look at the Wintax 2017 program again and bring over the auto summary, you can see our total income of 665,854, and there's our tax due of 179,640 after the primary rebate, and there's our 6 Quad limit plus pay as you earn paid, and there is our due by you amount of 23,739 Rand. The final page of the Wintax 2017 report will show us that the forfeit amount calculation has been replaced by the 6 Quad regulation calculation in this case. Depending on the figures, we've seen that forfeiting a portion of the tax deducted offshore may not be enough, and then SARS brings Section 6 Quad into play. 6 Quad is also a bit more complicated than it looks initially. When calculating the deductions to be used to determine taxable foreign and taxable local incomes, you have to apportion deduction claims for things like retirement fund claims, etc., according to the foreign and local incomes. This is only fair, as if you earned half of your income from foreign sources, then it makes sense to say that half of your deductions, like retirement fund contributions, were funded from your foreign income, and half your allowable retirement fund contributions can be used to reduce your foreign taxable income.